Alright guys, welcome back to the channel, and in today's video I want to show you I want to talk about a topic I titled identifying a complete market structure before trading. And in this very video I'm going to show you what a complete bullish market structure is going to look like and what a complete bearish market structure is going to look like also. And there are some trades I took yesterday I'm also going to show you as part of the examples. Then I can also take you back to some other examples which some trade I did previously. So let's quickly talk about, not just the bullish and the bearish. I can also show you examples too on a consolidating market. So these are the three types of market, the major three types of trend in the market. So you need to know how to identify a complete market structure before entering any of those markets. But the most traded market are the bullish and the bearish market. So let me increase this to 1 month. Now let's read what I wrote here. Starting from this very place, I wrote some things which I said before entering any trade or having any setup, you must be able to identify the market conditions. Then these conditions can actually be in form of your criteria or your checklist before executing the trade or before your execution. So I wrote a complete market structure are rare to find these days, but they have the most high probability of playing out. They have the most high tendency of playing out. For me, I define my risks of my trade based on the checklist for a particular trade entry model. Now, let me simply explain what that means. So, a particular trade setup can actually, there's this thing they always say, this is the Ace plus setup. That means they are very, very sure about the setup. So, for your risks, or for me, my risks is based on the type of the trade entry I get. So, let's just say I have my checklist to be like 6 criteria I'm looking at for price action to or for market to perform, and I can completely see 4 complete market structure or market price action. That's more like a high trade probability. And for a high trade probability, you want to risk more on that particular setup or trade because it has a higher chance of playing out. So my own risk is defined on the kind of market I see, and I have a low risk or low trade probability, a medium trade probability, and a high trade probability. So my risk follows just the same way. If it's a low probability trade, I'll risk very low. If it's a high probability trade,
Perfect.
I'll risk very high. Then if it's a medium, I'll just risk medium. There are some low probability trade I don't even take at all. Yeah. So that's just how I trade, and that's how I want to show you how to trade like that, because it's going to save you from too many losses now. So I wrote something here. Examples there. In any bullish trade entry model, my checklist for a complete market structure includes number one. Let me read what I wrote here. A run on liquidity, that's IRL. IRL is internal range liquidity. I talked about internal range liquidity. Internal range liquidity can mostly be found on the lows. So if you're looking for a bullish market or you're looking for a market, so you want to have that liquidity has been swept. Sorry guys. So this low here is going to be your IRL here. So that's your internal range liquidity. Then number two, a visible shift in market structure on the 15 minutes or 5 minutes. Then number three is price mitigating my PYI at the daily, weekly, or the 4-hour time frame. So let's just assume that we are viewing this chart from the 4-hour time frame, and we have that price have mitigated our 4-hour PYI, which is checklist one has been passed. Then taking out the IRL, which is this low internal range liquidity, as price is coming in to take out internal range liquidity, just like I explained in my liquidity video. If it's going out for external range liquidity, where you have this high to be an external range of liquidity. So on the 15 minutes, this is a 4-hour time frame, and we've swept our liquidity IRL, which can also be our point of interest because it's a liquidity area, is where I'm interested in the market. So since price have swept liquidity, that's past criteria 1, then we want to see price mitigating our point of interest, which is this IRL liquidity level criteria, so have been passed. Then the next one here is having a smooth shift in market structure on the 5 minutes or on the 15 minutes. Now, just like I've always explained, whenever you take a liquidity out, you expect a reaction of price. So this reaction here, if you zoom into the lower time frame, this reaction here, we should be able to have a visible shift in market structure. So let's just say now we zoom into like the 15 minutes, and we have a visible shift in market structure here now. So this is our shift in market structure here now. So that's criteria 3 has been passed. Then the fourth one is having a target, a nice target. That's ERL. This is where I wrote it. So having a nice target, having a nice price, having a nice target. Now, what do you think will be our nice target? The ERL, which is the external range liquidity, which is this. Let me increase this to like 2 months so I can get enough space here. So this is it, having a nice target. So a nice target is the next liquidity, and the next liquidity is this external range liquidity, which is the high. The lows are internal range liquidity. If price is going up, it's going out to take external range liquidity. So if you still don't understand, you can watch my liquidity videos. So this is the nice target here. So criteria 4 too has been met. Then the fifth one is price mitigating an inducement before going. So let's just say this is what. Let me now redraw everything. Let's just say using a low time frame. Let's just say we are taking our trade from a 15-minute time frame. So let me redraw everything and let me like draw everything back so you can understand with the clear schematic diagram. So let's just say this is a bearish market. We are about to turn bullish on the 15 minutes. Now, knowing fully whether everything is okay, let's just say yeah, we reacted to a higher time frame. Okay, sorry, let me do this. So this line is going to be a higher time frame point of interest. That's number one. Then like the IRL, the internal range liquidity, and we have price to start dropping from here. So now this is a higher time frame, and this line now is a higher time frame point of interest. So we've automatically gone to the 15-minute time frame, which is our time of entry. And on the 15-minute time frame, guess what? We want to see a sweep and a shift at the same time. So this is now going to be the shift in market structure from here. Criteria 1 has been passed, 2 have been passed. Price has mitigated the higher time frame point of interest. It has taken out the IRL, the internal range liquidity, and we've created a shift in market structure now. That's 3/6. 3/6, guys. So the remaining 3 is you want to see price taking out an inducement. Now this inducement is a form of liquidity, and FVGs and IFVGs are also a form of liquidity, which can be also known as liquidity void. So in case there is no inducement and there is an FVG, it can still serve as an inducement. So that's just like a substitute for an inducement. So let's just say price can now either come into this FVG this way and push up. Then criteria 4 and 5, your nice target is this drawn liquidity here, which is the ERL. That is it here. So this is where you have your entry, your long entry. I'm going to show you real life examples. Then your stop loss is going to be below here and thereabouts. So that's just it. Now you have this to be high probability setup because it has met all your criteria. And the last criteria, which is very, very important, is that you always want to take your trade from a discount level when you're buying. So you bring in your feed retracement below the 50% level. You put from this edge to this edge. So if price is below here, then you're good. So that's it. So this one is a clean market structure. Alright, let's go into the examples here I have. So this was one of my examples. This is the trade I took yesterday. So you can see that this is a weekly time frame. You can see this sweep in market structure, like this sweep of the IRL, internal range liquidity. So I went to as low as the 15 minutes. Now on the 15 minutes, what do I have here? I have a shift in market structure. I also have a sweep of liquidity. If I should take out this weekly IRL, I also have a good sweep in liquidity here. So this is a sweep of the internal range liquidity twice, which is a good confidence level, which is good to build my confidence level. Then I have this fair value gap to substitute as my inducement. Price retracing into this fair value gap after I shift in market structure was already there to substitute as my inducement, although this is also another kind of inducement, this low. So I was either expecting price to, after filling up here, retrace. I almost got stopped out. I was expecting price to retrace, take out the liquidity, then give me a new shift in market structure before I can now join completely. But seems like price already delivered from this level already. So I also have a nice target too. I had a nice target. Now this was my target, this drawn liquidity. This was the external range liquidity, and this is the constructed liquidity. So this price action was very, very complete. Then if you go further to check on other pairs like EuroCard, I had some trade on EuroCard also. euro card. Let's go to the daily time frame. You see something here in the daily time frame. Same CRT entry model. This is what I mostly trade. See here, price took out liquidity from a very long term here. This liquidity was swept from this high, which is a long term liquidity. So I went as low as 15 minutes. Now on the 15 minutes, this is what I have, and I'll tell you why I also lost the first entry. Number one was wrong timing, and number two, I entered at the discount price. I was actually selling at a discount price, which was bad. I'm supposed to sell at a premium price. Let me show you here from the fib level. So I sold below this price action here. So I was supposed to sell around this level here. I was supposed to sell around the premium price, but I sold in the discount price. That was why I lost. So price actually went to the premium price. Now this is another thing. Now look at what happened. So this one I've met two criteria, taking out the external range liquidity, because this is a bearish scenario. If it's a bullish scenario, we'll be taking out the IRL. Then if you presume this is a kind of sweep in inducement here. Price took out liquidity, which is taking out inducement, created another shift in market structure. Then this was where I got my final second entry. This is this one. After the shift in market structure, this retracement. Then now, one of the last characteristics or criteria to make sure you have a good setup is having a nice target, which is this low. You can see this low was one of my liquidity points here. So let me also take you to another example. I still have another example, same on this euro card, still CRT entry model. Okay, this is it here, CRT entry model, that's candle range theory. You check on the 1 day. So if you check on the 1 day here, you can see what we have here. This is a sweeping liquidity at this very level here. So a daily liquidity has been swept. Liquidity swept from previous day up to like 4 days here. So price took out this daily liquidity. Then let's go to this range about the 15 minutes of this level here. So 15 minutes of that level. You can see after the sweeping liquidity here, I have a shift in market structure, and price retraced into a key level. Although I was not around here to take my first entry, created another shift in market structure. When it retraced into this fair value gap, which I told you is either price retraced into a fair value gap or take out an inducement. So as at this fair value gap was when I took this entry. Now, what did I say again? You must have on your checklist a nice target, which is this low. You can see how price is actually reacting to all the liquidity level, which is the IRL here. You can see how price reacted to this other one, which is actually a good thing you should understand. You must have your exit and your entry strategy, guys. So let me take you to another example too on USD card. So this is USD card, and if you see what USD card did here, price also took out this. Let me first of all go to the higher time frame, which we ought to use every time as our point of interest. So we check on the 4 hours here. USD card. Okay, on the 4 hours, this is what happened here. 4 hours, external range liquidity was swept. Look at it here. External range liquidity was swept here. So after this push, I saw this price, took out this liquidity, which was the IRL first checklist, first criteria on the checklist. Then I went to as low as 15 minutes here. 15 minutes. This is what I have on 15 minutes. Okay, this is one of the perfect example here. On 15 minutes, we have the price has taken out the external liquidity, created a shift in market structure, retraced again, this is an inducement price formed below this fair value gap. Then you can see how price took out this inducement, created a shift in market structure here. Although I was already in this market just below the inducement. Now, even after the inducement, price gave you a complete price action again. So this setup is more like an A plus setup, where you have this to be your shifting market structure at this level. Then you now have price to retrace into. This fair value gap here. Then you can see enter from here. Targeting this another point on liquidity, you can still enter a price from here, having here to be a stop loss. Then you can enter from there, targeting this external range liquidity also. Now with this, you've actually mitigated your loss or your risk, which is almost the same thing. So that was how I got this USD card. Let me show you two more examples before I call it a day. These are examples of complete market structures. They are at least performed 5/6 of what I have on my checklist, and if you see, they actually performed well. They are high risk and high trade probability setup, A plus setup. Let's go to AUD card. Now AUD card, let's go to daily time frame. I say you always want to see your point of interest being mitigated on the higher time frame first of all before you can take any trade. So AUD card was still more like a CRT model entry, where I have liquidity to be taken out from this previous day, and also this one here. So you see, there were two kind of liquidity. Liquidity was swept from all these days, daily time frame, and also this last one here. So this was the last one I was looking at here. Let me zoom in where you can see the last candle. These are CRT entry. Most of them are CRT entry model, but it's still like a sweep of liquidity here. So liquidity was taken out here. Then I went to as low as 15 minutes here. Now you can see as low as 15 minutes. This is where we have liquidity to be taken. So let's delete it. Then as low as 15 minutes, you have your market structure shift. Although this very price action was very, very noisy, but I had to go down to 5 minutes because it was very, very noisy here. You can see how that place looks like. So you barely can identify a good shift in market structure. So it was on the 5 minutes I got this shift in market structure here. So you can see, then you can see how price retraced inside. You can see how price retraced inside here. Taking out this inducement. It is an inducement. Price retraced inside, taking out this inducement. And where are we going to? You must have a nice target, like I said. You check on the 30 minutes. This is a nice target of drawn liquidity. The IRL. So this is it here. This is a nice target, and you can see the reaction as soon as price took out liquidity. We were already going up. Let me check for one more example before I go on NZD card or USDJPY. I think I traded any of them. So in this case of NZD card, my own point of interest was on the 4-hour time frame, where I had this order block here to be my point of interest, and below the order block we have this to be an inducement. This were breakout structures I drew out. So price retrace into the order block. Then you can see if I go to the 15-minute time frame, which I will use for my entry. So on the 15-minute time frame, you can see this clear market structure shift here. And after the market structure shift, it retraced a little before going to the inducement. Inducement was taken. So we actually went up to a nice target. Where is the target? Let me show you. Drawn liquidity, which was this old high here. You can see the liquidity sign. Let me check 30 minutes or 1 hour so you can see that sign. Okay, this is the liquidity here. This old high. So that old high was the liquidity that price took out from this level here. So the last one is AUD card. Okay, I think I've mentioned AUD card. Let's just do GBP USD. So I do trade a lot on different pairs. Let's check out GBP USD. Let's go to 4 hours here. Okay, look at it here on the 4 hours. This is what we have here. Look at now on the 4 hours we have this to be sweeping liquidity. Look at here. This was the sweeping liquidity from a very long time. You can see this old high, and here this is the sweeping liquidity. Let me zoom in again so you can see the way liquidity was taken out with that candle wick, very slight, very small. Then if you go to like 15 minutes, which are my time frame for entry, zoom in. So look at this trade here. We had a shift in market structure. This was the breaker block entry model. We had the target on liquidity, which was this low, and that was how we got this trade here. There are other trades. This one was not a high probability setup. You can see where I took this trade. The only thing that was on this market was a sweep on liquidity, and maybe price reacting to this other block, and you see price did not fully go to TP here. So just a little push, we did not get to our target here. Or maybe price just used the most recent liquidity as a target, which was this one. But I was actually looking out for more trades, So price just actually used this one, which was not really nice enough. So that trade was not really a good one. But I have too many other trades I've taken on GBP USD for some time now. Okay, this very one, we look at them here. which was a sweeping liquidity. I got stopped out here trying to manage risks, and this one too I also got stopped out here. All these ones were low probability setup, but this one was actually a nice one, a high probability setup. This was a higher time frame point of interest, a 4-hour order block. We had an inducement, price took out the inducement, then went to this nice point of liquidity here, which was this high. So that will be on the video.